All right. Cool. Just wanted to make sure I went live. So YouTube recorded this for everybody. What's up, everybody? Welcome to another fundamentals forecast stream. First, I'm going to go through the charts real quick, and then we're going to jump right into recession updates, where we are in the overall economy, and why this week is one of the most important weeks for fundamentals and for economics in general. So I'm going through the NASDAQ 100 index. This is the instrument that I trade predominantly. I'm going to go through some of the updates from this morning. I did send out a link to the ChartAddicts members, the private members group this morning, so we could cover what was happening in the markets before I went and had my cash removed. I came back and I actually ended up taking shorts on the break back inside the London session highs. You guys know my strategy. It's pretty straightforward. Consolidation before the market opened. We had this massive push to the upside, double top. The market broke in and created resistance at the previous London session highs. And I basically just took the trade down to about 363. Should have held longer, but that's the way the cookie crumbles. So now we have price breaking back above the daily support level. So we had this massive shift back up above the daily support. If price continues to get stuck right here at 12,335, then we're going to see a push all the way back up to the top of the range. So this is a pretty straightforward move. You'd be able to measure that previous impulse. So the 61 is right there at 335. Retracement down. And then TP1 is 12,400. TP2 is 12,466. Now, I personally would not take the long positions. I would wait until they hit those targets and then continue shorting. And obviously, we'll explain why the market is going to be shorting this week when we get into the fundamentals. So this is let me show you guys a larger time frame before we jump to another pair as well. What we see from this morning is that price hit this massive double top and then respected this head and shoulders. Price ended up closing. Well, it didn't close, actually. The body of the candles closed above support. But all of these wicks violated into the lower range and created 1, 2, 3 different rejections. And so there is bearish interest to take us down into this range. Let's keep that in mind. So if price, and this is the zone I'm watching here on the left, this shoulder, turn to support. So support turn resistance, this area at 12,350. If we close above that zone, then all we have to do is simply wait for a retracement to 12,350 and then short it to the bottom of that range. However, just like I said, if the market continues to form support at 12,350, so that same exact zone, if we use it as support as opposed to resistance, then that's going to indicate a push back up to the top of the range. So this is a bearish week. We have the FOMC is going to be releasing their rate statement this week, and they're going to be raising interest rates. So we're going to see, are they going to raise it by 75 basis points? Are they going to raise it by a whole percentage? Who knows? And so what we're going to be doing is preparing for a bearish week. And then as the market fundamentals start to play themselves out, we can just take advantage. Higher time frame. We're still bearish. We hit the 78 resistance. We're still rejecting and creating some bearish movement. I do want to see a pullback to 540 later this week. And so this is kind of what I talked about in the call yesterday. We're going to have some bearish action. We'll have some bearish action. And then on Wednesday, we'll probably retrace all the way back up to the 12,570. And that's where we can get a short. So sort of like this teacup sort of situation. Okay. Everybody clear? NASDAQ, we took shorts today. There's no shorts right now. If you want to take any trades, what I would do is play inside of this range for the day. So for example, if price breaks above the London session low, which is at 12,360, closes above, you can wait for a retest. This is kind of some intraday trading stuff. You can wait for a retest up to the top of the range and then potentially all the way up here. So hold a runner. So that's a possibility. Another possibility is price closes below, we can wait for a retracement and short, or just wait for this thing to create a double top, and then we can short it down off the double top. That's what I'm doing personally. This is the only trade I'd be looking to take today. And the TP1 would be this previous high right here. So TP1 would be 12,400. Nice 70-point move here. Any questions on NASDAQ? U30, just like we were talking about, is continuing to respect the 61 as support. Unless we magically break below, I mean, not magically, the markets can move however they want, but unless we break back below, the market is still forming higher lows here. And I am expecting price to push up to 32,700 before we get a massive liquidity push. Okay, before we get a massive sell-off. Okay, I'm going to talk about this on the fundamental stream, but I'm going to show you guys what the White House said today. That was complete BS. They released a statement. Actually, it wasn't today. It was like 2 or 3 days ago. They released a statement about recessions that we need to talk about. So GJ, I was expecting a retracement, which, price still hasn't broken above that level, so we still might get this retracement. But you guys can tell we've already been pushing bullish. So we have higher low, higher low, higher low, higher low. I am expecting price to break out. I'm expecting price to break out of this resistance. The only thing is we need to find a good entry. And so here's 2 options for entries. I got on the 4-hour. I realized that price had already rejected. So we've already made higher lows and we've already had a nice bullish push to the upside. And so a nice idea would be retracement back down to the 50 and 61 range, this previous area of support, which would put us at 164, the psychological level. 1 retest, push to the upside. Price has already made 1 rejection here. This is, I want to butcher the name of this candle, but it is longer on the downside. So it's sort of like an inverted hammer. We could fill this to the downside, retrace about halfway, and then continue. That would be a trade worth taking, in my opinion. If it doesn't give that retest, no entry. What else? What else? What else? Dollar index is still inching a little bit lower. It's still inching lower, but I am expecting the dollar to continue back up. So if you guys are in anything that has a USD at the end of it, so basically if you guys are looking at GBP USD, you're looking at Euro USD, you're looking at NZD USD, those should be continuing bearish, okay? They should be continuing bearish here pretty soon. We're going to get 1 more push down on the dollar and then a continuation. So for example, EU, still expecting, maybe 1 more push up and then a drop. Or if we continue to form resistance here, this triple top or quadruple top, this will be an indication that the market is going to short. So at some point, EU will continue shorting. GU will continue shorting. NZD USD will continue shorting. AUD USD will continue shorting. All right. Any questions, comments, concerns about the markets before we hop over to fundamentals? All right, pretty straightforward. So that's the and we could check this later while we're on the stream. The stream is gonna run for a good amount of time here, so we're chilling. Alrighty, y'all. Anybody have any questions that you guys want me to go through first? Anything that you guys want me to talk about in the economy before I jump into my whole spiel? All right, so we'll start talking about some hit news here. We'll talk about the White House press statement on recession. I'll kind of break down what this means because obviously you guys are gonna like, okay, here's my goal for these streams. You guys ready? Here's my goal for these streams for the entire recession. The mainstream media is going to get out there and talk about some hit topics. Whenever something big happens, there's going to be some hit topics that everyone's going to get hung up on that we'll be able to kind of, you know, that they're going to be using to push a narrative. So Bloomberg might have a narrative to keep panic low. CNN might have a narrative to keep panic high because viewership is higher. So they're going to be talking about recessions and they're going to be talking about, job markets and inflation and all these topics that are going to be hidden behind a narrative that they're trying to push. So I'm going to try to find out what those topics are that they're going to be talking about and get you guys the sauce up front. So you guys don't have to go through the bullshit of listening to them not sugarcoat, but basically put their own twist on all the fucking news all the time. Okay? That's the real goal here. It's so weird because I just got this cast off. And so like I haven't been able to bend my arm. And so even like touching my face is something I haven't done in probably 4 or 5 weeks. Very, very strange to finally get a cast off. I don't know if you guys have ever been in that spot. So White House press statement. Janet Yellen, head of the Secretary of Treasury. She's basically in charge of the piggy bank of the United States, and she's the former Federal Reserve chairman. She says that the economy is not in a recession because the technical definition of a recession is no longer accurate to define what it is. Long story short, they're basically changing the definition of what a recession is damn near 3 months before we go into one. Does that make sense? So we're seeing an economic slowdown. Everywhere except for labor has taken a hit. Consumer demand is starting to come down. Consumer sentiment is low. PMI and producer indexes and producer sentiment, manufacturing sentiment is all down. All of the key factors that we look at for a healthy economy are negative. However, they're trying to claim that we're not in a recession because we haven't had 2 consecutive quarters of GDP growth. The article that I wrote a couple months ago, the one that was talking about the recession that's coming this year, I mentioned that the technical definition of a recession was outdated. And so I agree with what she's saying. However, this is not how you do it. They basically came out here and they're changing the definition of how they view recessions 2 months before we go into a full-fledged recession. That's just a dirty game, honestly, because they're trying to, I don't even know what they're trying to do here. I think they're trying to reduce panic, but I would much rather they come out and just tell the truth for once so that the market can react appropriately. We can have the panic early, take the Band-Aid off early, and then kind of have some smooth sailing going into next year. But no. So basically what she said is, if the definition isn't 2 quarters of negative GDP growth, then the NBER, which is the National Bureau of Economic Research, this random organization, which up until 2 years ago I hadn't heard of, and up until this year nobody gave a fuck about. All of a sudden, they're the ones who are in charge of fully marking when a recession is in. So it's no longer economists can sort of look at the landscape and say, we've had 2 consecutive quarters of negative GDP, and so we're in a recession, in which case everybody can prepare. Now it's like, no, this group of people, this NBER, they're going to tell us when we're in a recession. Until then, don't panic. Everything is cool. What the fuck does that mean? Now, when we talk about what is the difference between those 2 definitions? All right, 2 consecutive quarters negative GDP growth. GDP is the gross domestic production. It's basically the size of your economy. Goods and services, imports and exports, all consumer, demand, all consumer transactions in the economy. Everything that makes up the economy is part of the GDP. Did we expand and grow like we're supposed to be doing every year, or did we contract? When you contract for 2 quarters, each quarter is 3 months out of the year. We're split up into 4 financial quarters. When you have 2 quarters, so 6 months of negative GDP growth in a row, that usually signals that we're in an economic slowdown and we're in a recession. The NBER looks at kind of like a more holistic approach. They look at labor, so how many people have jobs. They look at inflation. They look at wage inflation, or people getting paid. They look at, manufacturing sentiment and all these other things to determine if we're in a recession or not. We're going into one. We're going into a recession for sure. The fact that they're trying to change the definition last minute, that's what's kind of sketchy. Now, how do I read this? They would only be trying to reduce panic if they didn't think that a recession was actually coming, or if they thought a recession was actually coming. I think that the federal government sees a recession coming. They're trying to reduce the amount of panic, trying to get everybody to Q2 numbers come out and being like, oh, 2 consecutive quarters, we're in a recession, short everything. Instead of creating that sort of panic, they want people to look at the labor market, which is still healthy. They want people to look at consumer sentiment. They want people to look at inflation, which if inflation starts coming down, the Fed will turn on the printers again, right? And so I think that the government is trying to get people not to panic because they know that we're in a recession. Long story short. All right, so let's look at some key metrics here. I want to get you guys not only looking at headlines. If you guys watch this stream over the next 12 to 18 months while this recession plays itself out, you guys will all become experts. Not just experts on how this shit works, but how to take advantage of it, which to me is the most important part of all this. As I do my research on this, because I don't know all the answers. Let me be completely honest. Every single week, I have to do a good amount of research. I have to call in old friends from the finance industry and basically talk around to see how some of the largest banks are forecasting. Some of the central banks are forecasting. I might call private hedge funds and ask them how they're managing their private wealth. How are they looking at portfolio rebalancing? And I sort of get all this information. As I figure out a play, I'm going to let you guys know. So you guys are going to be basically doing this journey with me for this recession watch over the next 12 to 18 months. As I find opportunities, I will let you know, and we can all take advantage of them together. All right, I think that's pretty exciting. I don't know about you guys. So let's look at some key metrics. I'm going to go to the Bureau of Labor Statistics. I'll show you guys the sites that I look at. Bureau Labor Stats. Oh, not salary. Oh, hell no. So there's the Bureau of Labor Statistics. There's the NBER, the National Bureau of Economic Research, which basically dates the business cycles of the economy. But they were never the ones who were in charge of calling a recession. They just kept track of the economic business cycle. So there's that. And then there's the St. Louis Federal Reserve Statistics website. This is straight from the Federal Reserve. So here's some trending search topics. Usually that's what I start off with first. All right, really lazy. I'll get onto the Fed website. I'll look at the trending topics, CPI, GDP, inflation, unemployment, basically everything that I just mentioned in the past 5 minutes. Then we'll look at the M2 money supply, the interest rate, 10-year treasury rate, which is basically what the federal government is paying for us to buy bonds nowadays. So if you want to buy a bond from the government and hold it for 10 years, what are they going to be paying you? So those sorts of things are very important to investors. And this is basically all of the information here. So let's start off with CPI. CPI is the Consumer Price Index. It's basically the costs or the change in cost of goods and services in the economy, all right, in the consumer economy. Sticky CPI, this is like, we're not going to get into too many details on these calls, but sticky CPI is basically long duration, something that's going to stick around. And regular CPI is more shorter term. So you can think of sticky CPI like mortgage rates. You can think of sticky CPI as used car prices, things that don't really fluctuate that much. They'll go up and down. Produce, for example, that goes up and down with the changes in the environment. And so it's not sticky. And so if like the price of some produce that you normally buy, avocados, lemons, pistachios, sugar, coffee, some of those like really expensive imports, those are going to be up right now just because it's harder for us to move stuff around the world. We're dealing with a supply crisis, and some of those costs are going to go up. But as the economy starts to resettle, those prices come back down. Now, mortgage rates, they don't just go up and down and up and down with the business cycles. They'll have a period of high inflation like we've been seeing, and then we'll have a correction if there is one later this year, and then we'll have a continuation of that trend. But the fact that prices are now a lot more expensive than they were before, that's here to stay. And that's kind of what we can consider sticky CPI. But let's look at the inflation rate. So the gray bars here, this is kind of just to explain how the St. Louis Fed does their numbers. All these gray bars are recessions. All right, every time there's a gray bar, recession, recession, recession. What this chart is showing is the inflation rate since 1950. Now, everybody's kind of talking about inflation nowadays, so it's important for me to explain to you guys how inflation was calculated before this thing went fucking rampant. The Federal Reserve had an inflation target of 2% a year, which means that every single year they wanted the growth of the economy to be expanding at such a rate that prices were going to go up by 2% every year. Now, that's healthy because if we're not growing at all, right, then that's just going to be bad for the overall state of the economy. And when you grow an economy, when there's more production happening, when more people have more jobs and are getting paid higher, naturally prices will go up. So inflation, or the change in cost of goods and services, was usually an indicator of economic health. Because if shit was growing, if businesses were making more money and people were getting paid more, then the cost of bread was going to go up. Where did we go wrong? What broke? Well, basically shit broke as soon as we got into the pandemic. The Federal Reserve printed way more money than they could afford to print. Well, not really than they could afford to print. How do I explain this? The Fed printed way too much money. And all this extra money slushing around the system caused the prices of everything to go up. Everybody felt richer. Stocks were at all-time highs. Mortgages were at all-time highs. Cryptos were at all-time highs. When people feel richer, they spend more. When people spend more, the prices of everything goes up. That party went on for way too long. Halfway through 2021, once we finally conquered the pandemic, we should have reduced the amount of money we were pumping, but we didn't. The federal government was so scared of going into a recession that they decided to continue to print money in tandem with the Federal Reserve. So Federal Reserve was printing it, giving it to the Treasury. The Treasury was giving out stimmy checks. All right. When you pump that much money into the economy, the cost of everything goes up, and we have an inflation crisis today. So where we're at today is the current inflation rate on a year-over-year basis is 9.1%. The cost of overall goods and services have gone up by 9.1%, or expected to go up by 9.1% this year. That's huge for a lot of people. Now, everybody here, I use these examples all the time, but look at the things that we all spend money on the most. It's going to be food and energy, food and gas, right? And you can include energy. I'll include energy as a whole thing. Your light bill at your house and the heating bill and the AC and everything else. Light, so it's energy and food. Both of those have gone absolutely crazy this year. All right. They don't count that in the adjusted CPI numbers. The adjusted CPI numbers, so there's headline CPI, which is what we're looking at right now. All right. That's everything. All the cost of goods and services mixed in together. And then there's core CPI that does not include food and energy. All right. So it's adjusted for that. That one's a lot lower. And so we're not seeing a lot of inflation in random stuff. Most of the inflation is actually coming from the food and energy. Asset inflation is the one that's gone the most bonkers, and that's the one that had to come down. So I don't know if you guys were on the stream that we had a couple months ago. We talked about the different types of inflation. One of them is the consumer inflation. The shit that we all buy is getting more expensive. That's not good, right? Because unless we're getting paid more, unless I'm getting a raise at my job, I'm in a worse situation by having to pay more for goods and services. Then there's asset inflation, where stocks are going up, crypto is going up, mortgages are going up. So if you're an asset holder in this country, which keep in mind, that's only a small percentage of this country. Only a small percentage of this country owns assets like stocks, mortgages, bonds, cryptos, and things like that. So if you did own that stuff, you were feeling extremely rich because of the asset inflation. And then there's wage inflation. Wage inflation is that the cost, or is that the people are getting paid more at certain jobs, and is making the landscape more competitive. So everybody has to start paying more, and that just means that if everybody's getting paid more, the cost of goods and services will go up after. All right. So this is like, those are the different types of inflation that we were seeing. The consumer inflation wasn't that bad until Russia took advantage of this, of our weakness, and started to hike the price of oil. All right. The current cost of commodities is up 300% in the past 6 months. So that's rare earth minerals, that's oil, that's fucking uh other commodities like gold, silver, everything that's a commodity, especially manufacturing commodities, they're up significantly. Now, who benefits? It's people who have large mineral deposits, and that's their economy, i.e., Russia. So Russia has actually been getting paid 3 times as much to export its oil, 3 times as much to export its rare earth minerals, 3 times as much to export metals and commodities. And basically, the whole world is financing their war through this increase in prices. So the inflation that we've been seeing wasn't that bad. Russia saw that the inflation crisis was going to get worse. They kind of chose a pretty opportune time to fuck up all the supply chains in the world. Now, all of a sudden, energy and food went up because 30% of the world's fertilizer comes out of Russia. That's what we all need to make food. So food prices went up, gas prices went up, and then all of a sudden we can see the CPI number is going through the roof. So what does the Fed need to see to start printing again? Is a reduction in inflation. If the prices of shit comes back down, the Fed doesn't care anymore about crashing the economy, and we can keep going forward. Until then, the Fed has one job: crash the economy and reduce demand so that we can get inflation under control. Reduce demand and crash the economy means we're going into a recession. So the Federal Reserve has chosen to send us into a recession in order to avoid an inflation crisis, which is way worse. And that's the landscape that we have. So when the money printer comes back on, we'll see crypto go back and reach all-time highs. We'll see the stock market go back to all-time highs. We'll see the bond market recover, and we'll see the housing market start to get some liquidity back. When the Fed turns on the printer, the entire economy comes back to life. When will the Fed turn on the printer? Right? When something breaks. If the stock market dips by too much, right now the stock market is dipping, the NASDAQ 100 index is crashing, US 30 is crashing, SPX is crashing, okay? If they crash by more than a specific percentage from high to low, if they drop by too much, too fast, the Fed will step in and start printing. They'll tell everybody, hey, look, our job is done. We crashed the economy. Inflation should be coming back down now. Let's start printing again. And so we, in the market, how do we take advantage of this? It's the part that you guys have been waiting for. Now that we got the context, where are we? How do we take advantage of this? Well, if we know that stocks are going to keep crashing, if we know that crypto is not going to recover, and if we know that the dollar is going to keep going bullish until the Fed starts printing, then we short stocks, right? We dollar cost average into cryptos, and basically that's it. All right. And we go long the dollar, any dollar assets, UJ, UCAD, we go short GU, EU, assets like that. So we can spot trade this stuff on the short side, and then we can pick up assets in our investment portfolio. Spot trading is a short-term day trading opportunity for cash flow. Now, some people swing trade, I understand it. Taking that money and investing into long duration assets, meaning things that you want to hold for 3, 5, 10, 15 years, that's how real wealth is created. It's by investing in something you believe in for the long term and allowing it to compound on itself through compound interest. So you'll be taking the money that you're making from trading the market to the short side during this recessionary period and reinvesting it into long duration assets at the dips. And then after the recession's done and the market recovers, we'll all be in a better economic situation or financial situation. Does that whole playbook make sense? So cash out at the top when we print, go long and then short. No, the other way around. You'll go short on the stock market because the money is drying up in the system. But then you'll go long. Well, you'll go short in your MT4. So if you're day trading or spot trading or margin trading, you'll be trading the smaller time frame trend, which is down, right? Look at the stock market trend. Since January of this year, we've been trending lower and lower, lower and lower. So in my MetaTrader, I'll be shorting. But then when I go to withdraw, I'll be investing that into long duration assets that I believe are going to be around for the long haul. And so that's any of those big tech companies that we were watching. That's the Teslas, the Amazons, the Facebook, the Googles, anything that you guys thought had value but was always way too expensive. Now might be the time. This is not financial advice. Obviously, please do your own research and consult a financial professional. But how do we invest? How does the average person invest? You invest in shit that you use, right? Because then you don't need to be a market analyst. If you're out here like, what should I buy? Well, look around. What are the things that you buy the most? I got an Apple Watch on my desk. I'm using a MacBook. I have a fucking Apple phone. I have the charger right here. I have the headphones here. I have the right. Why the fuck wouldn't I buy some Apple stock? Should I just be a consumer my whole life and just feeding the beast? Right? Or should I be owning a part of this thing? So even though I'm paying for all these consumer goods, one, I have my eye on the ball as an investor, and two, I can take advantage of the growth of this company. And so if by buying things that you use, you'll stay away from having to know too much and having to look at the comp deals that they're giving out to their shareholders and how the right. If you're using the new iPhone, this thing is trash. It keeps like the battery life is getting worse and worse. You know that's not good. All right. If the new generation of every phone is getting worse, if the new generation of every AirPod of every watch is getting worse, that's going to be a very big red flag that you should get rid of some of your Apple stock because you're like, dude, this company's going downhill. But if every single time you go upgrade your phone, upgrade your headphones, upgrade your watch, you're like, you know what? It's not what, they didn't fix all the problems, but this thing is getting better and better. Then you know that this company is sticking around. These are companies at the end of the day. And so that's what I look at. I use my day trading to create short-term cash flow, and then I'll take out the cash flow and invest it into long duration assets. That's the playbook. All right. So we looked at a few of those stats. We looked at CPI, obviously just been on a huge uptrend. Let's look at the the US Bureau of Labor Statistics. So this is what I use from all my employment data. Anything related to employment, I want to go here first. And so there's four main employment metrics or benchmarks that I look at. One of them is the quits rate, how many people are quitting the professional economy. I look at the unemployment insurance claims, how many people are filing for unemployment insurance benefits on a month-by-month basis. I look at obviously like the headline unemployment rate to see how many people are working in the economy. And so that's kind of how I look at the employment numbers. Oh, I also look at the JOLTS numbers, the amount of open jobs. So we kind of went through this last time. I'll give you guys the quick math rundown. There's 12 million open jobs in the economy today. It's 11.25. I'm gonna round up here for simplicity's sake. There's 12 million open jobs. The unemployment rate came out at 3.6%, which is complete bullshit, but we'll let them have it. So 3.6%. Oh, I forgot to say, there's 150 million able working people in America. 150 million able to work in the economy. So 3.6% of 150 million, let's do some math here. 150 million times 0.036, 5.4 mil. All right, so there's 5.4 million unemployed people. Those are people actively filing for unemployment insurance. And then we have 12 million open jobs, which 12 million is about all right, so this is basically a landscape that we're working with right now. We have 150 million people in the US economy that are able to work a job. There are 5.4 million of those people that don't have jobs. Now, 5.4 million people unemployed is a huge number, but if you look at it as a percentage of the total people that are able to work, 3.5% is really fucking good. That's actually 10-year lows if I go and pull up the chart. So then, if the labor market is so strong and we have all these open jobs, is this enough to save us from a recession? If we go into a recession, won't people just fill these open jobs? So in reality, if the unemployment rate does start to climb, we go up to 5.5%, people start getting laid off, the number of open jobs is also going to get reduced. Okay, because a lot of these are job openings. But you guys can see Coinbase actually had, I think it was 200 or 300 people in the pipeline that had already signed a contract to work, and they terminated the contract saying that we're on a hiring freeze. We'll keep you in our pipeline for the future, but as of right now, we won't be hiring anyone. And so we'll start to see demand for jobs start to go up. So there will become more unemployed people in the economy. And this number will start to shrink. Obviously, a bunch of people will take these jobs from this unemployed pool, but there will also be a lot less corporations inviting people to come work. That is where the recession really starts to get dangerous. So if that does happen, if this unemployment rate does climb too far, too high, too fast, the Fed will print the money. So I trust the Fed. I trust them to send us into a recession early and then to get us out of one if shit gets too deep. All right? I look at these metrics. I'm basically trying to gauge this story, and I just track it on a month-by-month basis to see how it adjusts. All right, y'all. So anybody got questions about the state of the economy, why we're headed into a recession? If not, let's talk about this week and then we'll wrap this stream up. He said this, that sauce, so much good information to capitalize off of. Come on, you guys already know. Let me give you guys the sauce for this week. First off, they're going to try to spike the market bullish on Wednesday because we're all positioned to the downside. We're all positioned bearish. And so let's be completely honest. They're going to give us bears for the beginning of the week, just like we're seeing now. And then we're going to smash back bullish right after. What? I just got some wild text messages. All right, all that aside, let me show you guys what is happening this week. So there's two big news events that are releasing this week. First one is GDP. Okay, this is up until this week, up until the Fed, or up until the Janet Yellen wants to change the definition of a recession. This number this week was going to confirm what I've been saying, which is that we are in a recession. If this GDP number that comes out this week came out negative, it would have confirmed that Q2 of this year up until July 1st was negative. We had 2 consecutive quarters of negative GDP growth, and it's going to send the economy into a massive recession. That releases this week on Thursday. On Wednesday, we have the interest rate news. The current interest rate is 1.75%. That is what the member banks of the Federal Reserve need to pay in order to borrow any funds from the Federal Reserve. They are looking to raise this interest rate to 2.5%, which means that they're expecting an increase of 0.75%, which is 75 basis points. All right, so now everybody in the world is prepping for this. You guys can see, even while we're on this chart, that NASDAQ is crashing as we speak. The market has opened up bearish in anticipation of this news. Okay, this news is extremely bearish for the markets. And so everyone's starting to prep for this. Now, if they come out and they don't raise it by this much, they come out a little bit lighter, less aggressive, more hands-off. Hey guys, we're testing what's happening in the economy. I don't expect the economic conditions to get worse, and we're only going to raise 50 basis points. If Jerome Powell says that, the markets are going to recover bullish like crazy. If the number comes out higher than 2.5%, which means that they raise the interest rate very aggressively, very quickly, it will indicate to the market that they are trying to really slow down demand because things are a lot worse than they seem, and that will cause a massive crash in the market. So if the number comes out higher than 2.5, the markets are going to crash to oblivion, like the Big Short type deal. Not the Big Short type deal. Let me not hype it, but the markets are going to fucking crash. If the number comes out lower than this, like 1 point, let's say they only raise it by 50 basis points, then we're going to have a bullish recovery because it shows that the Fed is getting less aggressive, which means they're seeing something we're not. They're seeing things start to get better, so they don't need to be as aggressive. Now, if the number comes out as expected, what happens? If the number comes out as expected, what happens? There's going to be a massive whipsaw to shake out everybody that thinks that they're smart and they saw this coming, and then they're going to short. But that whipsaw is going to kick out just about every short seller. All right? That's the playbook of these markets, people. That's the playbook. So we continue to short over the next few days, and then on Wednesday, hopefully we get that massive pullback on the higher timeframes. Now, I'm strictly talking about tech stocks here, but you guys can apply this to U30 as well. I want to see this pullback later in the week for shorts, or maybe even a little bit higher. Okay, we'll reassess that later in the week depending on how markets close. So that's the playbook. That's this year, or sorry, that's this month. What's happening, and then this year in a nutshell. We're in a recession. Fed's trying to stop it. If the numbers start to come out positive, where we at? All right, so 2 p.m. That's the news on Wednesday, and then Thursday we have the advanced GDP quarter over quarter. Yep. So this is the second quarter GDP data. The previous was 1.6. So the first quarter of this year, the first 3 months of 2022, we had a negative 1.6% growth in GDP, completely negative. The forecasts are expecting a 0.4% growth in Q2, which means that no recession, nothing bad. This number is not accurate. Let me tell you guys this right now. If the markets don't crash on Wednesday, they're crashing on Thursday, just off the fact that economists are really forecasting a positive GDP growth. Where the fuck are they getting this from? People, I'm doing back of the napkin math, and I can almost guarantee that we're going to have a negative GDP growth in Q2. I don't know why they're expecting a positive reaction here. So if the markets don't short on Wednesday, they're definitely shorting on Thursday off of that news. Plus, we have unemployment claims coming out. Oh my God. So much news this week. Pending home sales on a month-by-month. Core durable goods sales. So much good news. Boom, boom, boom. All right. We're not going to go too deep into any more on the recession just because I feel like I don't want to confuse anybody. I feel like at this point, everybody here, you and I are on the same page. I feel like if we go longer, we might start to confuse some folks. But let me know if you guys have questions. I'm going to leave the last 5-10 minutes for Q&A. I'll answer you guys' questions about the economy. If not, we'll call this a day. I appreciate all of you guys for showing up. If you are on YouTube, make sure to hit like and subscribe just so that the algo boosts this thing and we get some clout from it. And so you guys get notified next time we do one of these streams. All right, so looking at some of these questions on YouTube, is this going to be posted on YouTube once it's over? Yes. Do you trade on the 1 minute time frame? I try not to. Okay. Thanks, bro. Trying to get better with Naz. Practice makes perfect. Oh, he said news. Yeah, honestly, just look at the big picture. That's the best advice I can give. He said spam, get out of here. Yeah, I just hid the user. They were being really, really annoying. So thanks for your time. No doubt, Brian. Good to see you on the YouTube stream. All right, ChartAddicts members, if you guys are on the Zoom call, if you guys have any questions, let me know in the chats. Anything about the economy, charts, whatever it is. When I turn off the YouTube stream, if you guys want me to cover a few trades, let me know. We can do that for sure. All right, looks like there's no questions. Looks like there's no questions. Thanks for the info. Hey, bro, come back Wednesday and Thursday with the fundamentals. So every single Thursday, we live stream to trade. Every single Thursday, we live stream strictly trading. I'm going to be trading the indices. So I will be shorting NASDAQ on Thursday. Don't say I didn't tell you. All right. Don't say I didn't tell you. Thursday, I'll be shorting NASDAQ. I'll be doing it live on YouTube. So make sure you guys hit subscribe so you guys are notified when we do go live. And hope to see everybody there. Says now I'm finna match the fundamentals with my technicals. That's what you have to do. Because you're gonna get these slow ass moves, little ass moves, little ass moves, little ass moves. And then every once in a while you get a big news event. And so if you're like, oh, you know what, I don't feel like trading this week. If that's the week that you're choosing to not trade, you're missing out on a big opportunity. So if you know that there's a high impact news event, and you're lining it up with the fundamentals or with the technicals, you'll find an area that you're looking to short from, and you'll basically just wait until it hits, and you'll get a much bigger move than on an average day where you're getting, there's no volatility, there's no volume there. I'll go live for ChartAddicts members for sure on Wednesday. That's without a doubt. All right, y'all. If you're watching this at home, again, my name is Roy Dunya. I'm the co-founder and CEO of ChartAddicts. If you guys are interested in learning how to trade from us, we have everything from courses, live streams, live trading, just like we're doing now. So chartaddictsfx.com. Highly recommend that you guys go check us out. We got almost everything you need. If you're interested in trading signals, we just launched the Enigma app. That's enigmafx.app if you guys are interested. And of course, if you're interested in personal coaching, reach out to us through email, info@chartaddictsfx.com. We'll be sure to get back to you. All right, everybody, take it easy. Peace.